When investing in a company, it is important to know how to read and analyze its income statement. This document tells you how successful the company has been in generating revenue and making profit. In this video, we will discuss the different components of an income statement and explain what they mean for investors. We will also provide examples of how to use this information to make informed decisions about where to invest your money. If you enjoy such content, then make sure to like this video, subscribe to our channel, and turn on the notification bell icon to never miss another upload of ours. Here we begin. What exactly is an income statement? An income statement is one of the three financial statements that businesses use to assess their overall financial health. The other two are the balance sheet and the cash flow statement. An income statement provides a snapshot of a company's revenue, expenses, and profit for a specific period of time. This information can be used to assess a company's financial performance and make decisions about where to allocate resources in the future. There are a few things to keep in mind when reading an income statement. First, it is important to note that an income statement only reflects transactions that have already occurred. This means that it does not provide any information about future revenue or expenses. Second, an income statement should be read in conjunction with the other two financial statements to get a complete picture of a company's financial health. Finally, an income statement can be presented in different ways, so it is important to understand the format that is being used. Why do companies have them? Most people know that companies have an income statement, but many do not know why. An income statement is one of three important financial statements that companies use to make informed decisions about their business. The other two are the balance sheet and the cash flow statement. The main purpose of an income statement is to show a company's profitability over a period of time. This information is important for management in order to make informed decisions about where to allocate resources. Investors can also use it to assess whether or not a company is a good investment. There are several ways to measure profitability, but net income is the most common. Net income is calculated by subtracting expenses from revenue. Expenses includes costs of goods sold, operating expenses, and taxes. The income statement can also be used to show how a company is performing compared to its competitors. This information can help make strategic decisions about where to allocate resources. Overall, the income statement is valuable for companies and investors. It provides insights into a company's profitability and performance over time. Acknowledging this information, management can make informed decisions about allocating resources. Similarly, investors can use the income statement to assess whether or not a company is a good investment. The high-level theory behind the income statement. Let's make this informative by using Apple and its income statement. An income statement is a company's financial statement that indicates how much revenue the company brought in during a specific period of time and what expenses it incurred during that same period. The income statement can be prepared on a quarterly or annual basis, but most publicly traded companies release their income statements on a quarterly basis. Apple Incorporated's income statement for the fiscal year ended September 30, 2022 showed total revenue of $265.595 billion and a net income of $57.486 billion. Apple's total revenue for the fiscal year was up 21% from the previous year, while its net income was up 36%. The main components of Apple's income statement include total revenue. This is the top line item on the income statement and represents the total amount of money that Apple brought in during the fiscal year. This figure includes revenue from all of Apple's businesses, including its iPhone, iPad, Mac, and services businesses. The cost of goods sold. This is the second line item on the income statement and represents the cost of goods sold during the fiscal year. This figure includes the cost of manufacturing Apple's products, as well as the cost of any components that are used in those products. The cost of sales is the direct cost associated with the production of the goods or services sold by a company. The cost of sales includes the cost of materials, labor, and other expenses directly related to the production of the goods or services. The cost of sales is typically expressed as a percentage of total revenue. For example, if a company has a total revenue of $100,000 and its cost of sales is $50,000, then its cost of sales percentage would be 50%. The remaining $50,000 would be gross profit. Gross profit. This is the third line item on the income statement and represents Apple's gross profit for the fiscal year. Gross profit is the difference between total revenue and total cost of goods sold. This number represents a company's profits from its core business activities before accounting for other expenses, such as marketing, overhead, and taxes. A high gross profit margin indicates that a company is efficient at generating revenue and keeping costs low. For example, a company with a gross profit margin of 20% means that it earns $0.20 profit for every $0.80 of revenue generated. Different industries have different average gross profit margins. Operating expenses. This is the fourth line item on the income statement and represents the company's expenses for the fiscal year. Operating expenses are not directly related to the production of goods or services, but are necessary for the operation of the business. Operating expenses include selling, general and administrative expenses, such as advertising, rent, salaries, and utilities. Operating expenses are typically expressed as a percentage of a total revenue. For example, if a company has a total revenue of $100,000 and its operating expenses are $40,000, its operating expenses percentage would be 40%. The remaining $60,000 would be operating income. Net income is there. This is the bottom line item on the income statement and represents Apple's net income for the fiscal year. Net income is calculated by subtracting operating expenses from gross profit. Net income can be positive or negative, depending on whether a company's total revenue is greater than or less than its total expenses. For example, if a company has total revenue of $100,000 and its total expenses are $105,000, then its net income would be negative $5,000. Why do companies break down their revenue into different categories? First, it allows companies to see how each area of their business is performing. This information can then be used to make informed decisions about where to invest money and resources. Another reason is that breaking down revenue into different categories can help identify areas of the business that are not performing as well as others. This information can be used to make changes and improvements in order to boost overall performance. Finally, breaking down revenue into different categories can help companies compare their performance against their competitors. This information can be used to develop strategies to improve market share or even create new products and services. So there you have it, 3 good reasons why companies break down their revenue into different categories. Why did management really want to focus on growing services side of business? Management really wanted to focus on the growing services side of business because they saw it as a way to increase profits. They believed that by offering more services, they will be able to charge more for their products and make more money. However, they failed to realize that customers are not always willing to pay more for services they don't need or want. In many cases, customers would rather go without the service than pay extra for it. As a result, the company's profits have actually decreased since they started focusing on the services side of their business. Companies need to remember that not all growth is good growth. Sometimes it's necessary to take a step back and reevaluate your strategy in order to ensure that you're actually making the most of your opportunities. Otherwise, you could end up doing more harm than good. What do you think? Do you agree with management's decision to focus on the services side of their business? So next up in the line is other income and expenses. Other income and expenses are those that don't fit into the traditional categories of income and expense. They can include items like capital gains or losses, foreign currency gains or losses, and interest income or expense. While other income and expenses can be significant, they're often one-time items that don't significantly impact your overall financial picture. As such, it's important to take them into account when considering your financial situation, but don't let them dominate your thinking. Instead, focus on the big picture items like your regular income and expenses. That's where you'll find the most opportunity for improvement. So what do you think of other income and expenses? How to think about projections and analysis of the income statement. When it comes to projections and analysis of the income statement, there are a few things to keep in mind. First, you want to ensure that you include all relevant income and expenses in your projection. This includes both one-time and recurring items. Another thing to keep in mind when projecting future income is tax implications. Depending on the type of business you have, taxes can have a significant impact on your bottom line. For example, if you are a sole proprietor, you will want to include your estimated taxes in your projection. If you are a corporation, you will want to consider the impact of different tax rates on your bottom line. By taking taxes into account, you can create a more accurate projection of your company's financial performance. Finally, when creating projections for the future, it is important to think about what could happen that would change the numbers in your projection. For example, what if one of your major customers decides to stop doing business with you? What if there is a recession and people start spending less money? By thinking about these things in advance, you can make sure that your projection is as accurate as possible. So, by understanding how to read and analyze an income statement, investors can understand a company's financial health and performance. While there are many different ways to analyze an income statement, some key things to look for include revenue growth, expenses, profitability, and cash flow. By understanding these key income statement components, investors can make more informed investment decisions. Thanks for watching. We hope this article has helped you learn more about how to analyze an income statement for investing. If you have any questions or comments, please feel free to leave them below. And don't forget to like, share, and subscribe to our channel.